When a farming business loses money, special tax rules can be utilized to help soften that blow. One of them is called operating loss rules. And joining me now by telephone to take a look at that is today's Rural Money segment, our own ag law professor, Roger McEowen, good friend. He's with Washburn University School of Law, joining us today from Topeka, Kansas. Roger, always good to visit with you. Let's start, I guess, by talking about the basics for the farming net operating loss rule and the carryback rule.
Yeah, sure, Mark. Good to visit with you. Well, until the changes that were in the legislation enacted in December of 2017, you could carry a farm net operating loss back 5 years or make an irrevocable election and forego that 5-year carryback and carry the loss back 2 years. So a farmer had a choice, go back 5 or go back 2, and then you can use it to offset income in those years. Now, those were the rules that were in place through 2017, and it's particularly beneficial that a farmer has the ability to carry that loss back 2 years because that's an open tax year. And if you took expense method depreciation, the 179 election, if you made that in that year, you could revoke that election if the loss carryback would eliminate the need for the election. So that was a really big deal and was very beneficial for farmers.
Now, do I understand that taxpayers can elect to forego that carryback?
That's right. You can elect to not carry your losses back and carry them forward under the prior rules up to 20 years.
Now, elsewhere, can what I call non-business capital losses exceed the non-business capital gains?
Well, no, they can't. This gets us into the changes made by the Tax Cuts and Jobs Act in December of 2017. Non-business capital losses cannot exceed non-business capital gains, even though there might be an excess of business capital gains over business capital losses. Now, this is important because under the changes made in December of 17, starting for tax years beginning after 17 and before 2026, so there's a sunset on this, farm taxpayers are limited to carrying back up to $500,000 on a married filing joint return of NOLs. And if you exceed that threshold, you have to carry them forward as part of your NOL carry forward to the following year. And the other important change that was made in the December Tax Act, starting in 2018, is that your net operating losses can only offset 80% of your taxable income. It's no longer 100% offset.
Very good. Roger, where can our viewers and listeners learn more? There's a lot that we could talk about, but just a short time we have here, I know they want to learn more. Where can they do that?
Yeah, there's a lot more that I've written just on this particular topic, and they find that on my blog, and that's accessible through my website, which is washburnlaw.edu/WALTR.
Very good. Roger, thanks as always. Good to visit with you. Listening to Roger McEowen, Washburn University School of Law, joining us from Topeka, Kansas.